Hi, good afternoon, everyone. The taxation of trusts has been a hot topic for as long as I can remember. I think in the 1980s, the Margo Commission was first tasked with reviewing trusts. Margo Commission looked at fairness, neutrality, and simplicity. I think we all agree that there's very little simple about trusts and the taxation of them at the moment. We then had the 7C or the 7 anti-avoidance rules, which were introduced largely again to look at the capitalizing of trusts with interest-free loan accounts. These rules have not really been policed much by SARS, and I think there's a lack of understanding from an accounting and tax practitioner's point of view with regards to the implementation of these. The Davis Commission then recommended abolishing all of the rules and saying that trusts need to be taxed as separate taxpayers in their own rights. Recently, in 2017, we had the Section 7C taxing of the donation on interest-free loan accounts or free or low-interest loan accounts. And then more recently, with the introduction of the anti-money laundering and the grey listing, we've had to comply with all of the ultimate beneficial ownership. We had the change in the Trust Property Control Act, and there's been a number of compliance reporting required. Largely, the taxing of trusts or the rules around the taxation of trusts has not really changed. What has changed, though, is the reporting and the compliance requirements. And failure not to comply with these has got severe and punitive penalties, both for the practitioners, for the trustees, and ultimately non-compliance from a reporting point of view could ultimately affect the beneficiaries. Over the next two webinars, we will have a look at the parties affecting the taxation of trusts. You can have one individual who can actually wear two hats, one being as a funder or donor to the trust, and then with his hat on as a beneficiary of the trust. Each of those have got very different taxing rights and very different reporting rights. So over this time, we will have a look at who needs to be taxed, under what rules, what information is required, what reporting is required in those instances, and when are the taxes due, with remembering that trust in itself is the ultimate final taxpayer. So there's a number of taxpayers before the trust is actually taxed. We'll also then have a look at the attribution rules, how to calculate the attribution rules, and the fact that an attribution rule actually doesn't have any impact on the financial statements. And then with regards to the vesting and distributions, we work through a calculation on how to determine these amounts and what physical paperwork is required in the form of statutory reporting. So I look forward to you joining me to explore the nature of trusts, who the various taxpayers and the connected parties are, when the tax has to be paid, by who, and what the information is. The dates are the 9th and the 16th of April at 3 p.m. I look forward to you joining me then. Thank you.